Scenarios in corporate planning, overtrading and undertrading. So in this session, we will define what is overtrading. We will also explain overtrading with a scenario. We will briefly see causes of overtrading, which are inflation, taxation, excessive inventory and depletion of working capital. We will find out what is the remedy to overtrading and its differences from undertrading. So first, we will take a look at what is overtrading, the definitions of overtrading. Overtrading is a condition and happens when a business can't keep up with the demand for its products or services. According to Leslie A. Howard, overtrading is when a business expands its production without adequate financial support. Now, we'll explain overtrading with the help of a scenario. The classical scenario is when a business fulfills an order in an easy market, which it, in the usual business sense, cannot fulfill. So this might have demanded increased production and sales to meet a ready demand, inviting larger profits made as a result. So in order to capitalize the situation, all the profits made is pulled back into acquiring new plant and machinery, storage facility, etc., depleting liquid resources. Further, raw materials are purchased and finished goods are procured for direct resale in an attempt to capitalize, if not monopolize, the market conditions, which in turn making creditors to wait for settlements, etc. So in the meantime, what happens is that the production cost increases while debtor settlements are awaited. The story does not stop there. Between the time it takes for the raw materials procured to turn into work in progress and ultimately finished goods, the debtors of the business are waited for receipts, and the cash crunch in that sense may find the firm looking for liquid resources. Further capital may be raised to avoid the crunch in situations only if the balance sheet looked healthier due to a severe cash crunch situation, which the company is faced with now. So the company faces a severe cash crunch situation because of the fact that it is trying to fulfill an order which it cannot in the normal course of business. So that is what is the cause of overtrading. One of the causes of overtrading. But the important causes of overtrading are inflation, taxation, excessive inventory, and depletion of working capital. So let us see what is inflation, how it contributes to overtrading. So inflation is in an attempt to increase profits. Corporations buy more assets and properties at exorbitant prices, which ultimately locks up the corporation's fund with a real problem of cash crunch appearing as a result. So that is how inflation turns out to be a cause of overtrading. For taxation, how taxation is a cause of overtrading. So this is on account of higher earnings. Corporation tries to give out dividends in order to appease the shareholders. Higher earning does not mean excess cash at the corporation's disposal. Since dividends are paid out, higher taxes will be a burden on the corporation, depleting the available cash resource, leading to cash crunch situation. So that is how taxation becomes a cause of overtrading. Next is excessive inventory. That is, due to excess inventory, large funds of the corporation are tied up in inventory. And lastly, it is depletion of working capital, how it causes overtrading. That is when working capital or net current assets are scarce due to higher dividend payout, repayment of long-term loans, acquiring of fixed assets, or even trading losses, forcing a cash crunch situation in the hands of the corporation. Now, what are the remedies for this overtrading? The best remedy is that the corporation in overtrading can do is to rewind its operations back to normal stages where there is a match of sales forecast to its expectations considering the capitalization base, and hence always try to avoid the following symptoms seemingly visible to the bank, as in longer credit or shorter credit as is customary in usual situations, higher inventory turnover ratio, which should be avoided, where net sales by average inventory at selling price, where cost of goods sold is higher than the average price on the inventory. We should also avoid low current ratio, where current ratio is current assets which is less than current liabilities in this case. We also should avoid frequent cash shortages. We should avoid bad debts. So these are the things which have to be avoided, and that is actually the remedy for over trading. Now, what is its difference from under trading? Under trading means low turnover of working capital. It leads to a greater current ratio where funds are kept idle and not used diligently, and the firm finds trading at a level much below the level ratio where its installed capacity remains underutilized. So it's a direct opposite of under trading. So that is basically what is under trading, and that is how it differs from over trading. So this completes a session on over trading and under trading, which are scenarios found in corporate planning. Thanks.